Francois, and I'm just going to pull up my slides here now. Hopefully everyone is able to see them. And yeah, looks like they're up. So just to give you a quick sort of overview on what I'm going to be speaking about today, I'll give a quick sort of economic overview, global and more national outlook as well. And then break down into a sort of sector-specific look at real estate and what we're expecting over the coming year and quarters. So starting off really, GDP growth has been mixed globally. So the US has had quite strong growth over the last couple of years, notwithstanding the fact that 2022 looks quite weak in comparison to other countries listed here. That's really just a factor of the US having quite a strong performance over COVID and not having the same requirement for a recovery. When we look at the UK, they slipped into a recession in 2023. Germany is currently in a recession, albeit a mild recession. And Canada has been in a per capita recession for a couple of years now. So not great circumstances sort of the world over, save for the US. Now, just to speak a little bit about what got us here, coming out of the global financial crisis, we were in a really low rate environment. So money was extremely cheap. And that allowed central banks sort of adopt the mantra that they were going to borrow, spend, grow. And so long as their growth outpaced their cost of borrowings, that was all seen as sustainable. Now, that didn't really account for a complete shutdown of production that came with COVID. And not only did we have a complete shutdown of production, but we also had the requirement to print or borrow an awful lot more money to provide stimulus checks to the populace to make sure that people could keep their lips above water economically. Now, borrowing and printing all of that money and throwing it into the economy is essentially like throwing a lot of fuel onto a fire. Or in economic terms, you could say it's inflationary. So that is what sort of caused, as I like to call them, the terrible 22s, when the price of bread was sort of jumping up while we were in the queue in the grocery store. And those inflationary times for commercial real estate were particularly negative and impactful because maintenance costs went through the roof with wage inflation and just with the inflation of goods that are needed to maintain a building and utilities. But not only that, construction inflation impacted replacement cost valuations enormously and drove up the cost of insurance premiums. So all of these costs fell onto the shoulders of commercial landlords. And particularly large-scale landlords were very negatively hit because, vacancy was increasing in a lot of these prime assets at the same time that these costs were also increasing. So mercifully, we are starting to come back down to more reasonable levels. And we can see that, Canada is now at about 2%. And if you were to strip shelter inflation out of that metric, it would be far lower than that. We're almost even deflationary sort of stages in Canada. But this is really good news because it is somewhat good news because it's allowing central banks to cut policy rates, which is great for anyone who's sitting on a variable rate mortgage or anyone who's looking at a mortgage renewal coming up. Now, even with these rate cuts, we have seen that the 10-year bond has remained range bound, which means that the market has really priced in the rate cuts. And it means that the market really sees a little bit of risk on the horizon. And that risk has eaten up the policy cut. So when we talk about risks and we think to ourselves, well, what could that be, given that we're forecasting sort of muted recovery within GDP growth? But really what economists are looking at the moment is the inverted yield curve. Now, the inverted yield curve it happens when your short-term returns are higher than your long-term returns. And that shouldn't be the case. Why does that matter? Well, it's generally a pretty reliable indicator of a recession. And when you look at the Canadian market, it's accurately predicted the early 90s recession. It predicted the dot-com bubble and the global financial crisis. But it does sometimes happen, and it has happened in Canada without accurately predicting a recession. So we can keep our fingers crossed that we're in one of those outlier scenarios. But if you look in the US, it's been a far more accurate predictor of recessions. Now, I'm sorry, I've just realized I'm on the wrong slide. This is our inverted yield curve here. And when I say it's a far more accurate predictor in the US, I mean that it's accurately predicted 100% of recessions going back to 1955. It's only happened once, other than that, where it hasn't actually predicted a recession. That was 1966, and they narrowly avoided a recession in that circumstance. So it would be naive of economists and markets to disregard this, and that is really what's driving our 10-year bond holding at the rate that it is. But it's also probably a sign that interest rates, while they're going to probably come back down over the next couple of quarters, they're not going to go back to the levels that we saw prior to COVID and for basically the entire time leading out of the global financial crisis. Now, again, the good sign here is that the way that you combat an inverted yield curve is that you bring your short-term rates down. Those short-term rates are based on policy rates, so we can really factor in a couple more probably small cuts, but cuts nonetheless from the central bank on the policy rate, which is obviously good news for the commercial real estate market, and a bit of my segue into the sector-specific looks that we're going to have. So I'm going to open up here with office. And the reason I'm opening up with office is just so that we can get a little bit cheerier as we go on through the different sectors, because unfortunately office is still facing a few headwinds, and it won't be news to anyone on this call that it hasn't had the greatest couple of years leading up to today. But let's speak about why that is and where we see it going. So workplace mobility is still lower than the pre-pandemic, and that is particularly happening in large urban centers. So if you look at the left-hand side here, we can see that a lot of the main centers in Canada are seeing less sort of traffic through the city than we had before the pandemic. It's curious what's happening in Saskatchewan. I'm not too sure on that. But for the most part, people are staying within their locale and they're not commuting into the cities, which makes sense. In a lot of these larger cities, you've got, Toronto, Montreal, they have traffic issues, not entirely well set with public transport. And yeah, when you look then at the right-hand side of the slide, you can see that the countries that are performing better in terms of getting people back to the office, the France and Japans of this world, they've got very good public transport, and they live in small units in comparison to the people at the top of this list, being the Britain, Australia, Canada, US, generally suburban workers who have spare rooms in their houses that can be converted to offices, and a lifestyle that just suits the work from home a lot better than the countries at the bottom of that list. So looking into that a little bit more then, I think it's important to note that COVID is often noted as a grim reaper when it came to offices, but that's not necessarily the case. And there was a steady drop in utilization of office space from the global financial crisis up until COVID, to the point where we actually had less utilization of space coming into COVID than we did going into the GFC. So if we look at the study on the right-hand side of this slide, we can see why this is happening, because 50% of workspaces are occupied for an hour or less. So it's pretty hard to justify a punchy downtown rent if you don't think that people are actually going to be sitting at the desks and utilizing the space that you provide. Now, if we look around the world, we can start to see that it's a pretty global story when it comes to offices. Forecasted expansion of cap rates from CoStar is seen in the UK, the US, and Canada. Now, we also follow that with a slight compression over the next few quarters. And what's driving that is that we would foresee a tightening of the gap that has developed recently between headline rents and net effective rents. So the reason that gap has obviously sort of come up is because we want, landlords are trying to hold on to their headline rents so that they underpin the appraisal process. But that can't really go on indefinitely. So we foresee that shrinking back down. It's not going to be because net effective rents are increasing. It's going to be because headline rents start to adjust back down again. And when that happens, we'll be able to justify a bit more of a compression on the cap rates that we see in offices, and because they will be built upon more sort of steady rents within the market. We also see vacancy is steeply increasing, and it looks like we're just very negative because it looks like our forecast is just for vacancy to shoot up. But there is logic in this, and really it comes from the fact that just before the pandemic, office rents were extremely high, money was cheap, and it was really easy to make a development of office space feasible, and you could make it stack, and an awful lot of shovels went into a lot of ground in major cities around the world. So there's a huge glut of space that's only really hitting the market now. And as that starts to hit the market, we're going to start seeing vacancy increase. I guess putting it kind of simply, we have seen, inventory really jump up in a lot of markets, while we have also watched occupancy drop off a cliff. So that's not a great circumstance for offices, and it doesn't look great going into the immediate future. And breaking this down a little bit further, we can see that Vancouver has seen the largest proportional increase in office space. But I put emphasis in that on the word proportional, because in terms of square footage, Toronto has definitely seen the lion's share of space that's been added. Now, if you look at just downtown Toronto, between Dufferin and the DVP, for people who know the city, and south of Wellesley, we've currently got the equivalent of about 6 Empire State Buildings of available office space that you could move into today. And so that's a huge amount of extra space in the market, and it's over 16.5 million square feet. And not only that, but in downtown Toronto, we also have another 2.8 million square feet due to deliver before the end of next year. So things aren't necessarily going to get better with office anytime soon, but it will probably wash through, but it's going to take years as opposed to quarters. Now we can all breathe a sigh of relief because we're moving on from offices and on to retail, which is definitely a story of undersupply as opposed to oversupply. And retail, as I'm sure an awful lot of people on this call will attest to, has seen a bit of a resurgence over the last couple of quarters. And let's just speak about where retail's been and where it's going. So really, I just want to start off by saying that the retail apocalypse that was prophesized based on e-commerce was largely overblown. There was an increase post-COVID, but it's leveling off. And in Canada, we're still only sitting at about 6% penetration into the whole retail market. Now, Amazon has been selling books for about 30 years. So online retail has definitely had time to take root. Now, post-global financial crisis, retail construction dropped off a cliff, again, because of these concerns of online retail and the impact that it was going to have on bricks and mortar stores. So inventory really is not grown proportionally to population. Meanwhile, retail sales continue to grow, which you can see there on the left-hand side. Now, in Canada, this has been driven largely by population growth because of the per capita recession that I mentioned earlier, but they're increasing nevertheless. So it doesn't really matter why that's happening. There's still a demand for retail and retail space, particularly when we consider where the penetration of online retail has gotten to. Canadians essentially just like to shop in person. So we can really illustrate this by looking at a sort of global scale and just track how retail and demographics really work together. Because retail really needs a lot of people, and ideally it needs a lot of people with a lot of money. That's where retail thrives. So to show this, I wanted to just show inventory growth versus population growth and the impact that that's had on cap rates in different markets. So we see that the US marginally underbuilt, Canada materially underbuilt, and the UK marginally overbuilt. So keeping supply tight and getting supply tighter has really underpinned demand and cap rates in the US and in Canada particularly. And conversely, in the UK, we can see that, the broad expansion of cap rates that has happened on the back of them actually overgrowing their population growth rate. And we can see this play through into vacancy rates as well. The one country that overbuilt is seeing vacancy trend up, and the proportional trend in the other countries reflects the supply of new space relative to the population. So Canada is tightening at a faster pace than the US, and the UK is the only country to be expanding on the back of having built more space and not taken in more people. So let's have a look at Canada's inventory growth. because growth across Canada has been relatively muted, with less than 5% growth. Particularly low levels in key markets where we've seen the highest population growth, in key markets where we've seen the highest population growth. So construction inflation and land values have made it really tricky to build new retail space in these markets and to develop retail developments and make them stack. So that's holding back the supply of this space. And this is going to underpin liquidity and values, both capital and rental values going forward. So we can see that here when we look at rental growth in the key markets across Canada. They've all actually outstripped inflation, notwithstanding the fact that we had particularly strong inflation over the 2022 era. We're still ahead of that 24% mark that we've seen inflate since 2016 until today. So this is a really good sign for retail. I think one risk that's on the horizon is definitely a recessionary risk coming into the future. As I said, what you really need is lots of people with lots of money. But notwithstanding that, we've got tight enough markets, there is demand and consumer spending is increasing. So good signs for retail going forward. Now, that's a good segue as well into the next asset class, which is multifamily. And just because multifamily, I think, it's arguably the most demographic reliant sector in real estate. And the demographics in Canada particularly are going well. So the value is essentially underpinned by the incredibly strong population growth. In Canada, we've had over 20% growth since 2010. That compares to 8% growth in the US and the UK, which is really material, but over 20% is enormous. So this is putting stress on the housing market. And, that is causing the crisis that we're in at the moment. But when you look on the right-hand side here, you can see that we're actually building at record rates. And we're building at a faster rate per capita than even the US. And the US is a far easier country to get shovels into the ground than Canada is. So begs the question, what's happening here? And I think really what is happening is that we're moving from a supply-created crisis to an affordability-created crisis. The previous rule of thumb was that you would spend about 30% or a third of your take-home income on your housing, be that mortgage or rent. We've seen that go from 30 to 40 to 50 to, in some cases, even 60%. And this is naturally capping rents. So they can't go beyond that because people don't have the money to spend on it. And wages have not increased at the same clip that rents have. So it's putting pressure on these housing markets. Now, I want to just discuss the breakdown of this population growth to understand it a little bit more, because it gives a bit more context to this, and then discuss a couple, one of the opportunities that's there for multifamily and one of the risks as well. So first, just want to look at interprovincial migration. Interprovincial migration is really, really good for developers and landlords, right? Because the people who have moved from one province to another have already been established in Canada. They are moving really to open up more disposable income and to get a better quality of life. So Calgary has benefited enormously from this because they've got lower taxes, more affordable for now housing, and they've also had a really extensive and deliberate sort of marketing campaign that has focused on bringing people in from other provinces. So I can attest to this, having stood down in the subway in Toronto a couple of years ago, saw enormous signs saying, move to Calgary, you'll have a better quality of life. And I have to admit, I wondered who that was going to work on, but it seems to have worked on a huge amount of people. So Calgary is reaping the rewards. And this is why we're seeing sort of steady growth within the Calgary market in terms of housing costs, whereas we're seeing recession in other markets. So then we have to think about intra-provincial migration, which is people moving within their province but out of other places. And we're starting to see that in some of the major cities. So if we look at Montreal and Toronto, we see really large net negative intra and inter-provincial migration. So people are moving out of these cities. Now, why are they doing that? Well, it's because they've hit the cap of what they can afford to pay on their housing. Their wages haven't increased and they're not able to go that much further. So they're pushing out of the city a little bit more. So if we look at just Toronto in this, and take that as an example, we can see where they're moving to. And they're moving to what we would call the exurbs, not the suburbs. So this is beyond the suburbs. So in the case of Toronto, we're thinking Guelph and Peterborough and Barrie and the far side of Hamilton. And you wonder why that's happening. And it's because the housing stock is currently in the more suburban locations, owned and occupied and it's not freeing up for an awful lot of these families, and they can't really afford it. So again, we've got this affordability crisis. So in terms of the opportunity that I mentioned, I think, again, you've just got to look at the demographics. And when we look at this, we see that the old age dependency in 2015 overtook youth dependency. And that was the first time ever that that's happened. The fastest growing cohort within our society are 65 plus. So it makes you think about what is being developed at the moment and what stock we've got in Canada, because at the moment we've got a huge amount of condos in downtown locations in the cities. And these are generally marketed towards millennials, and they've been built for millennials with the amenity offering sort of catered to them. But the world is moving on, and millennials post-COVID have a couple of kids or a kid on the way, or they want to get out to the suburbs, so they've got a dog that they regret getting and they need to get a garden. And it really doesn't suit them all that much to take up condo space anymore. So this is a huge opportunity for developers. They can focus on the cohort that is actually growing at the fastest rate, and also are well capitalized and empty nesters, sitting with money that they can spend, and suddenly developers are actually able to underpin rental growth again, which means that they can actually put shovels into the ground again and start building. And so this would open up the market a lot. And, an added benefit to this is that it would open up an awful lot of housing stock in the suburban locations, and we could just get a bit of a more natural and healthy flow happening within the market again. So with the opportunity, I have to mention a risk as well, because I think it is just important to note this whenever speaking about residential markets, particularly in Canada. The average rate of return over the last 15 to 20 years in Canada has been about 8%, which is pretty good. But that has all been built, or not all, but an awful lot of it has been built on debt. And that's been very, very cheap debt. And that debt has now gotten more expensive. So we are starting to see that mortgage arrears are increasing. And really materially, we're seeing mortgage arrears over 90 days. And that's material because over 90 days, a bank can step in and start forcing a sale. So what we really need is for unemployment to remain low. It has ticked up slightly over the last couple of quarters, but we just need it to stay within the sort of range that it's in at the moment to avoid banks stepping in. As long as you can make payments on your mortgage, the bank's not going to step in. You can move to interest only. It won't have that much of a negative impact. But this is definitely a risk that's hanging over the residential markets, and it could have quite a material effect on values. So with that being said, we can move on to some sort of happier news than that little warning I had, and move on to commercial real estate's golden child, which is industrial. So industrial production and rail traffic, just speaking about the market and where we are at the moment. Industrial production and rail traffic have both remained strong, notwithstanding a softer economy. Where we see over about 2021, we see warehousing and storage increase materially. That was third-party logistics firms moving from a just-in-time inventory to a just-in-case inventory. So that pumped up the requirement for more storage on the back of the sort of downfall of a lot of our supply chains. So that has not capitulated over the last couple of years. So it's reasonable to believe that that's going to continue. So really, a lot of the economic drivers that are pushing on the industrial market are remaining strong. So that is the main thing and the first thing with industrial. So industrial rents have dropped materially, and I'm sorry, I just got a notification, but industrial rents have dropped materially, and that needs to be kept in context because it was a drop from an enormous high. We were at about 15% per annum industrial growth. That was completely unsustainable across the country. So when we see where we're dropping to, it's still in advance of where our inflation rate is, which means that really, we're still beating a fixed income asset as an investment because we're able to grow that rent over and above the level of inflation. So why are we comfortable saying that rents are going to continue to grow over and above the level of inflation? Well, if you put Canada onto the same scale as the US and put us all on US dollar basis, Canada actually starts to look, a lot of our Canadian cities look, like good value, and in some cases even quite cheap. So that's really where we see the, runway for additional growth here. Now, one story within industrial that I just want to debunk that a lot of people are talking about is that, large bay space is becoming vacant and available at a higher rate because we are starting to see large bay get higher vacancy rates. Now, this is happening because we had a huge amount, massive amount of speculative development that was done when money was cheap, again, before the pandemic and throughout the pandemic when demand was particularly high. So, it's kind of like where we are with the office market, where we've got this glut of new supply, but it's not at all similar to the office market because we are going to start absorbing it, and we just need a little bit of time for that to happen. So for me to sort of show this, I just wanted to look at clear heights, because high clear heights and large bay space are the ones that are coming onto the market and driving up those segments of availability and vacancy. So, at first glance, it would look like no one wants the really good space. But when you look at absorption, it's been consistently positive for high clear heights for the last 5 years. Now, it's been a little bit more shaky when you get at low clear heights. So really, when we look at that vacancy peak for over 35-foot clear height, we see that coming back down to market and regularizing extremely quickly. We're back to sub 4% vacancy on that high clear height stock by the end of 2026. So we're just getting this glut of space, it's saturated the market, and we're working through it through absorption. So just to sort of finish up on industrial, then I'll just speak a little bit about capital markets. And I think very simply put, tight markets with good demand remain liquid. So we are going to see capital values continue to increase and volumes remain in line with historical averages. They won't be as strong as the bull run that we've just come out of, but they are in line with the average over 2017, 18, 19, which is a more regularized market. And we've got the benefit of the price inflation that we've seen over the last couple of years. So again, great news for industrial, good runway on it. Just to leave you with a couple of key takeaways before I pass off to my colleague, Lisa. Really, there's cautious optimism globally with GDP growth forecast to recover in 2025. Inflation is normalized, monetary policy is easing, and the 10-year bond is remaining stable. So we can foresee that interest rates will probably remain somewhat elevated. Office values are impacted and have been impacted by increasing vacancy, stagnant rent growth, and inflation. The retail markets see a resurgence as demographics and curtailed supply are underpinning the value. And demographic shifts are the main drivers in our localized multifamily markets. And then finally, just industrial, it's good news on that front. Economic drivers are remaining strong and there's a lot of runway for a bit more growth. So with that, I will stop sharing and pass on to my colleague, Lisa.
Excellent. Thank you so much, Ben. And I will also be sharing my screen and essentially we will be walking through a couple of items very specific to the industrial market that Ben had just mentioned. There we go. So here right now we are in the CoStar platform specifically, and every pin now is a property that you are seeing. High level information, grey pins, off-market opportunities, potentially blue pins have an active for sale or lease listing attached to them. For the purpose of this example, for the industrial asset class, we will focus on Greater Golden Horseshoe and Toronto area. And we'll select the industrial asset type. So these are all the other assets that are tracked. We'll select industrial over 50,000 square feet. And what we'll do is we will use these 5,000 assets to understand what's happening in terms of vacancy, absorption, and under construction trends for these assets based off of their clear height to be able to compare anything with a clear height of a maximum of 20 feet versus anything above that. So again, just to separate those assets that have those lower clear heights versus higher ones. Here we'll go to the Analytics tab to use these trends for those 785 assets, 296 spaces available for lease. This is also preloaded right here, so we still have all of our criteria for up to a clear height of 20 feet. And right here, what we are able to see is there's still some construction. It's definitely still growing. There's about 310,000 square feet currently being built. However, absorption, even though it is going into a positive direction for this type of asset, it's actually still negative in terms of net absorption. So people are moving out of these types of spaces, it seems. And vacancy trending towards the slightly wrong direction, but 2.9% realistically, it's not that bad of a vacancy rate compared to other asset types. And now if you want to study these assets versus higher ceiling heights, I have it right here for you as well. So same criteria, Greater Golden Horseshoe, Toronto, industrial type for industrial assets above 50,000 square feet, but with a clear height now of at least 20 feet or more. And what this gives us is, of course, under construction, now we are well above the millions, 22.6 million square feet currently being built, which has also tied to a higher vacancy for this asset. But the absorption is positive now. We're at 4 million net absorption square feet for the past 12 months. This has slowed down over the past year, but again, it's still positive. It's trending in the right direction, which could lead us to believe that those tenants potentially or owners occupying industrial assets with lower clear heights are moving into those higher clear heights, for example. So this is a way of leveraging that CoStar information to dissect the information, as Ben has done throughout the presentation as well. And I will pass this back on to Ben and François.
Well, thank you, Lisa. Ben will be joining me soon. It's 1:40 almost, so we'll open this for questions. No questions. Ben, if you don't mind, I'll ask you a question.
Sounds good.
Bank of Canada's meeting is next Wednesday in 7 days exactly. What do you think is going to happen there in terms of direction of interest rates?
I think you can't say undoubtedly, but I think it's undoubtedly going to go down. By how much is the question. And that's really been the circumstance that we've been in for the last few months or couple of quarters almost. I would see 25 basis points as being very reasonable to come down. The Canadian economy is quite sluggish at the moment. There is a lot of logic in becoming less restrictive with our policy rates. And yeah, I think that it could be as much as 50. I think that's less likely than 25, but both of those are more likely than no change.
Well, seems to be good news. Do you think the market has already absorbed that within pricing, or you think there's going to be further price adjustments linked to that potential decision?
In terms of cap rates for real estate, I think it's a funny one because it lags a little bit. And sometimes you hear, there's been a little bit of a issue that people in the market have had where cap rates haven't dropped in step with policy rates. But really, that's because the policy rates are dropping because the central bank foresees, risk within the economy in the immediate term. So I think what the market is telling you when, your cap rate is remaining at 5% on industrial and it's not coming down by 25 bips, that's really the market is saying, look, let's just eat up that 25 basis points with risk in the immediate term. We'll see how this plays out. And then over time, it can regularize and it can come back down. But really, if the central bank is forecasting that They want to get more money going into the economy because they want to activate the Canadian economy a little bit more. That is not representative of less risk or equal risk. It's representative of slightly more risk. And at the end of the day, cap rates are created by adding your policy rate to your cost of, your cost of finance, and then adding on risk over and above whatever the 10-year government bond rate is.
Thank you, Ben. For the audience, do not hesitate to ask questions. You can post it on the chat. We are actively looking at it. In the meantime, Ben, how's the Canadian market, real estate, of course, is responding to ESG trends, according to you?
Yeah, that's actually a really interesting one, and it's something that I was looking into quite recently. With the LEED certified and BOMA Best and all of these different certifications and green certifications that you can get on buildings, it's interesting to track how that impacts the fundamentals of buildings in the market. And when you start actually breaking it down and comparing buildings with those certifications against buildings that don't have those certifications, you start to realize that there's a very, very marginal benefit to having a LEED certification or a BOMA Best. You'd wonder if it really justifies the time and expense and effort that's gone into it. And when I was looking into that, I started speaking to people in the market, and it became apparent that you're not doing it to really get any benefit in terms of, we can put this badge on and now we're going to let more space. But what a lot of people were saying to me was that ESG initiatives are just good business now. So a lot of the more institutional landlords and bigger companies are acknowledging the fact that, making your building more sustainable is just beneficial to them, especially in a market where we see vacancy increasing and a lot of costs falling onto the landlord. It's far better to be on a building that, doesn't have leaks and is well heated and, has triple glazing. It's a lot cheaper to take that space on and look after it than it is to look after something that's a little bit breezier and older. So really, I think we've gotten to a point which is very, very good for the market and for the world, basically, that ESG initiatives, when it comes to sustainability particularly, because they're really just focusing on the S part of the ESG here. But I think that we've gotten to a point where that's actually just good business now. That's why people are chasing down those certifications. It's not through, window dressing anymore. That would be my take.
Okay, thank you, Ben. With regards to opportunities for development across Canada, where do you see opportunities, particularly growing cities, underdeveloped regions? What do you see there?
Yeah, I think going back to the sort of demographic shifts and what we're seeing in terms of people moving out of large cities and, towards the exurbs, there's great opportunity there. And I would see great opportunity there in terms of not even development, but redevelopment and conversion. I think when we look at office markets in a lot of those places, there was a narrative that office rents were a little bit better insulated in suburban and exurban regions. We're starting to see that they're now actually getting impacted. And the only reason that they were holding on to their rents and staying strong was because they were easier offices to get to. But this sort of shift away from, full in-place office is going to impact suburbs and exurbs as much as downtown cores. Now, when you look at the office stock in a lot of these cities, like the equivalent of Hamilton or Peterborough, a lot of them are older stock that they're easier buildings to convert. Their floor plates are smaller, their fenestration is better. So, in terms of opportunity, I see that as being a place where you've got residential values going up, office values coming down, and where they may not be viable at the moment. As soon as that crosses, you're going to get commercial viability, and whoever is sort of moving on that first is going to get great returns.
Well, thank you again, Ben. One last question. We're at 1:45 Eastern time, and people have meetings starting in probably 15 minutes. So I'll ask you a difficult one. Cross asset classes, the four that you covered, high level when owners decide to sell, what does it look like in terms of liquidity across asset classes?
I would say that we've gotten to a point now where definitely even, cutting them into 4 different groups isn't really enough, because there's different liquidity within the different asset classes. But to look at it at a very high level, I would say retail is extremely liquid. The problem is that you can't actually get any of it on the market, because anyone who owns good retail is holding on to good retail. So, that is what's holding it back there. We're just not getting those transactions. Industrial, I think, is always going to sell. It's a little bit softer. You might have to wait another month or so before you actually get, contracts signed, compared to maybe this time 2 years ago. But it is still extremely good. Multifamily as well. I would say that really the impact on multifamily and industrial liquidity more recently has been down to capital markets. It's been down to the availability of debt and of money to float around. There is still demand for those asset classes, and people want to get into them. Offices is a tricky thing to move. There are certain companies and funds that are buying them. There's certain REITs that are staying active in that space. But it's, if you look at downtown Toronto, we've had, I think, one office transaction that was about $10 million. Other than that, we've got one that's been sitting on the market on Queen Street, hasn't had any movement as far as I know, at about the $50 million mark. But these are sales that would have been done off market, between 2 parties within a week prior to COVID. So, offices, no real liquidity, retail, not enough of it on the market for people to actually trade frequently in it. And industrial and multifamily, both extremely liquid, but just being held back by capital markets.
Thank you for this. It's almost 1:50. Unless someone from the audience has a question, we will close this. I wish to thank you, Ben and Lisa, for attending. My colleagues at Leyton will post contact info in the chat. Please, everyone, feel free to reach out to us directly should you feel more comfortable asking your questions under that mean. And thank you for your attendance, and please look forward for the next Leyton Connect. We will send notices. Thank you, everyone, for their participation.
Thank you.